Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions. Hey Reluctant Preppers, if you haven't heard, we've already started our monthly 1-ounce U.S. Silver Eagle thank you gift to one active Patreon subscriber each month, signed by your host, Dunnigan Kaiser, and you don't want to miss out on that.
Please help us grow by subscribing today at patreon.com/reluctantpreppers.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We're delighted to have this returning guest. He's a favorite with our viewers, and we've got lots of viewers' questions to throw his way. We're speaking with John Rubino. He is the author of The Money Bubble, which was co-written with GoldMoney's James Turk, and recently Clean Money, Picking Winners in the Green Tech Boom. He also runs dollarcollapse.com. John, thank you for joining us here on Reluctant Preppers.
Good to be back, Dunnigan.
We always appreciate it when you are a good sport, as you are, and willing to field viewers' questions. We've got more than we can offer tonight, so we're going to have to pick and choose. I've got one here that I thought was very interesting because I think it'll echo with a lot of people. Nave Child writes, "My father recently told me that in his view, the U.S. economy is rocking steadily along, most likely due to the propaganda from the government and media. What information can I offer to my father to illustrate the true state of the U.S. economy?"
Well, the biggest underlying problem that we've had for a really long time is how much debt we're taking on. You can generate good top-line numbers if you just borrow enough money to, for instance, get people back to work and manage inflation and keep interest rates at a certain level. But if you have to borrow excessive amounts of money to get those things, then you're not getting a good deal and you're creating problems into the future. And what we've done for the past 30 years is buy good current numbers with increasing amounts of debt. And we started really in the 1980s with the Reagan deficits and then just continued on through the Bush years when we doubled our national debt and the Obama years when we doubled our national debt. And now we're doing the same thing under Trump. And that's analogous to a family that maintains a lavish lifestyle by maxing out a series of credit cards. Things look good for them, especially if their neighbors don't know how much they're borrowing. They think that's a really successful family. They have a big SUV in the driveway, big screen TV on the wall, big nice house. But actually they're building up so much debt that the repo man is going to come and take their stuff away at some point in the not too distant future. And that's where we are again. We're at the end of a long credit cycle of 10 years this time, in which the government and the private sector have all borrowed huge amounts of money year after year after year and spent it. And that creates the illusion of prosperity, but not the reality of prosperity. Really, we're just digging ourselves deeper and deeper into a hole. And what we've seen lately, just in the last couple of months, is growing instability in the financial markets. And this is the kind of thing that precedes hard times. For instance, 2006 looked like a great year to people who were just looking at the headline numbers. But actually, we were taking on immense amounts of debt. We had a housing bubble, derivatives everywhere you look, massive amounts of corporate debt and consumer debt. And that all blew up on us in 2007, 2008. And we had the worst 2 years of economic contraction since the Great Depression. Since that time, instead of learning our lesson, we've continued to borrow more and more money, and now we're in much worse shape than we were back in 2006. We owe more money. The derivatives books of the big banks are actually bigger than they were pretty much wherever you look. The system is more highly leveraged and more fragile than it was back then. So when the next downturn comes, which it might be coming with the instability that's bubbling up in the financial markets now, we can expect even worse times than 2008, 2009, and maybe the end of this whole era of fiat currency and fractional reserve banking. The things that we did to blow up this credit bubble, which really began after World War II, are probably ending at some point in the not too distant future. In other words, we've taken them as far as we can take them, And now the only thing that's left is some kind of a gigantic crisis to wipe out this debt. We don't know what that crisis will be or exactly when it'll come, but it has to happen at some point because this debt is so completely unmanageable. And when it does, it'll call into question a lot of the things that we think of as just the environment right now. You know, the big banks that make loans in huge multiples of the capital that they have on hand, and governments with basically unlimited printing presses that allow them to create as much new currency as they want to and dump it into the system to wage war and win elections and buy off constituencies. And those things aren't financially natural, and they will come to an end in possibly the next downturn. If not, we might have one more cycle after this, but I doubt it. I think this is the time that will end the era of fiat currency. And we could be coming up on it pretty soon. This is, from an economic standpoint, one of the most fascinating times in human history, but also one of the scariest. If you aren't watching this from a safe distance, you're in danger of being sucked under by what's coming.
Before we let this question go, this person is talking to a family member who's being strongly influenced by the economic indicators that they're hearing touted on the news. And you made the analogy to like a neighbor's domestic economy, which you don't see the internals of. You only see the external facade or the flash as they spend their way into what appears to be flush with prosperity. So what is the close analogy if they're trying to make those parallels a little bit more explicit, because that was a pretty good overall analogy, but it's based on 100 underlying assumptions that maybe you or I may have been talking a lot about for the past 4 years. But if they're trying to talk to somebody, to help them to see what they have been intentionally led to not see over the past, what are a couple examples? And I think you mentioned, so you mentioned the housing bubble in 2006. So in other words, just when everybody thought that times were good because their home value and the homes were being overbid on and real estate prices were booming, people thought that's good times. But you were saying, no, that was the sign right before the bad times because it had become overheated and it wasn't based on, or when you said it's like somebody maxing out their credit cards, it's like, well, okay, so what's the analogy here? Our economy, they're being told we've got better employment, we've got all this commerce going on. What are some specifics that they can say, look, Dad, you're being told the economy is booming because of this, this, and this, but actually here's what's really going on in those areas. Employment is one. I know you've talked about honesty and dishonesty and stats in your talks that I've heard you give before, but are there some specifics that they can really help kind of connect those lines for the person who's just not seeing it?
Yeah. Well, let's look at it this way. When you buy something, two things happen. You got that thing that you bought, and you paid a price for it, right? And it's only a good deal. It's only something that improves your life if the price that you paid was acceptable. If you grossly overpaid for it, then you diminished your quality of life by giving away a lot of money in return for something that isn't as good as the money you gave away. And that's what we're doing right now, where everybody borrows money now, whether you're an individual with your credit cards or your student loans or your car loans, or you're a corporation where you're borrowing huge amounts of money to buy back your stock, or you're the government where you're spending money that you don't take in from taxes and borrowing the difference. Now, the unemployment numbers we get, for instance, where there are a certain number of jobs out there, and it's actually not bad in the jobs market right now. In the housing market, home prices are up. It's not bad if you're a homeowner. In most other aspects of American life, if you just look at that top line number, unemployment or home prices or any number of other things, it looks like we're doing okay. But that's just one side of the ledger. The other side of the ledger is, what did we have to pay in the form of borrowing to get this economy? And if we had to borrow too much, then, as with any other kind of debt, it lowers your standard of living in the future because you're borrowing from the future to consume today, and you got to pay that off at some point. So what we've done is created this gigantic liability out there, this debt that we have to pay off. So yeah, unemployment is, although you can quibble about the government's measure of unemployment. So we could talk about that, where it used to be that the government's measure of unemployment was actually fairly real. It was a good measure of how many people were working and how many weren't working. And today, what they do is, for instance, if you're an engineer, let's say, making good money, but you lose your job, so you count as unemployed in the government statistics. But then let's say you get a job as a greeter at Walmart for $12 an hour. They count you as employed again. And so in the government statistics, no change happened right there, even though your standard of living plunged. And then let's say Walmart puts you on part-time because they don't want to pay insurance for you, and you have to go get another job. So you're an Uber driver or something like that.
Mm-hmm.
And so you got these two part-time jobs, and between them, you're making barely minimum wage. And the government counts that as two jobs. So it looks like we're actually doing better. And furthermore, let's say you get disgusted with the whole thing and you leave the job market altogether. You give up looking for work, you stop working. The government takes you out of the statistics completely. You no longer count as unemployed because you're not looking for work anymore. And so that's today's unemployment number. If you added back in all those crappy part-time jobs and the people who have just given up and aren't looking anymore, you get an unemployment rate closer to 10 or 12% than the 4 or 5% that we have today. So that number is bogus. On the inflation issue, the government counts bread and milk and cars as part of the cost of living, but they don't count stock prices, bond prices, and home prices, because they say those are assets. They aren't part of the cost of living. But you know what? If you're an investor or somebody who wants to buy a house, the fact that those things are going up in price raises your cost of living. And if you include the financial assets like houses and stocks and bonds in the consumer price index, you get a much higher number. So inflation, honestly accounted for, is actually a lot higher than the government reports. But again, that's almost quibbling. I mean, those numbers aren't great. But I think the debt that we're taking on is really the underlying problem, because that creates a future disaster that people aren't really accounting for in their thoughts about what's going to happen next. You know, and we should be very aware of how much is being borrowed. But we're mostly not, because for the past 30 or 40 years, governments have been able just to print electronically or physically the amount of money that they need to cover the increasing debt in the system. So the limiting factor in this game is people's opinion about the currency. In other words, as long as dollars are seen as highly valuable and desirable, the government can keep creating as many new dollars as it wants to, toss them out into the world for real stuff, and keep the game going. But as soon as people figure out that there's a vast oversupply of dollars and euros and yen out there, and don't want to hold them anymore, then the game breaks down. And that will manifest as higher prices, because people, as soon as they get paid, will say, okay, I don't want to hold dollars, I want to go buy stuff with it. So they go out and they turn their paycheck into real stuff as quickly as possible at whatever price they have to pay. And that looks like inflation, because prices are going up. But what's really happening is we're losing faith in the currency, and its value is crashing because of that. And that's in our future. See, we've already seen the dollar, in effect, crash versus stocks and bonds and real estate, because that's where the inflation went. You know, the government created a huge number of new dollars, and it didn't just spread out evenly across the economy. It went into these financial assets and bid their prices way up. So that was inflation, but people just don't think of it as inflation. If they actually did, they would see the dollar crashing versus financial assets, and it would shake their faith in the ongoing value of the dollar.
I think you just answered another question from The Matrix Has You, who says, my question is, if money can be created in the push of a button, why would the stock market ever crash? And well, you're on your way to it. You did talk about the loss of confidence, right?
Yeah, well, see, that's an interesting point, because if governments can create infinite amounts of money, why shouldn't the stock market trade at infinity, right? Because that money would just flow into financial assets as it has, and stock prices would continue to go up. And that's not actually untrue historically. If you look at, for instance, Venezuela, just lately, they had a currency crash, right? Nobody wanted to hold the bolivar anymore. And they had massive inflation, but at the same time, their stock prices went up. Their stock market was one of the best performing stock markets in the world, not because their stocks got more valuable, but because their currency got less valuable. So the yardstick by which you measure the value of stocks was changing in a way that made stocks look more valuable, but they really weren't. That could happen here. You know, we could have the kind of inflation that pushes up the price of lots of different things. It wouldn't have to just be stocks. It could be all kinds of, you know, oil wells and houses. And, you know, that's happened many times in the past. That's just a basic garden variety hyperinflation where people stop wanting to hold the currency, they buy stuff, and the price of those things go up in that currency's terms. See, that's the important thing to understand is if you're buying U.S. stocks and U.S. stocks are soaring because the dollar is crashing, in real terms, in other words, in inflation-adjusted terms, you might not be making any money on your stocks. You might actually be losing money. But you have the illusion, they call it a monetary illusion, basically. The money is changing. Therefore, the price of things is behaving in ways that is a mirage. You know, it's not really true, but it looks true if you're not paying attention to the value of the currency. So yeah, stocks could continue to go up, but they probably wouldn't go up in real terms in a hyperinflation. You want to own the stocks of specific kinds of companies in hyperinflation, and that is companies that own real stuff that will go up in value, so their inventories go up. Like a gold miner, for instance, is the purest example. The gold they have in the ground goes up relative to the dollar, so the value of that gold miner stock goes up. Now, the opposite is true for banks, for instance. They own a lot of financial assets. They own bonds and things, which pay you dollars over time. So if the value of the dollar goes down, then the value of the income stream on bonds goes down, which means banks are less valuable. So stocks in general are not the issue. It's which kinds of stocks you would want to own in which kind of a financial crisis. And that's sort of the same thing as saying you want to own real assets. For instance, you want to own well-chosen rental properties, and you want to own precious metals in an inflationary environment. You want to own oil wells. And you can also own the stocks of companies that own those things and do well. But you've got to be very selective because there are many other stocks that won't do well. And so if you just buy an index, you buy a Standard & Poor's ETF, for instance, in an extremely volatile environment like rising inflation, some of your stocks in that ETF will do well, some won't, and so you'll kind of split the difference, and it won't be a great experience for you. But if you bought a energy ETF or a precious metals ETF, then most of what those things own would be beneficiaries of inflation. See where I'm going? You want to own inflation hedges during inflation.
Sure.
And so you can't talk about the stock market in general, but you can talk about sectors of the stock market that will probably do well in the kind of environment where there's a currency collapse.
I'm guessing that when you're talking about owning real things or owning the stock in companies that do own real things, you also have to be cognizant of whether or not those real things were already in a bubble prior to you getting on board. And I think that leads into this question by Cletus Smith, who says, with the loss of the credit system, what happens to people's mortgages? If the banks only crash, then will the banks confiscate foreclosed houses? And if so, then what do they do with all those houses for which there are no buyers?
Yeah, there are a lot of cross currents in this story. And, one quick conclusion to something like this a lot of people come to is that, I should borrow as much money as possible because maybe the banks will go out of business and I don't have to pay the banks back.
The biggest debtor wins, yeah.
Yeah, that's not, that's almost certainly not how it works, because somebody is going to own that mortgage somewhere down the line and you're still going to have to pay it back. And if you borrow a huge amount of money betting that the dollar is going to go down and you pay off your debts in cheaper currency, you got to be able to cover the interest along the way. Because if you get foreclosed upon while you're waiting for this to happen, then you lose everything, right? So it's theoretically a great idea to borrow a lot of money and buy inflation hedges, but it's incredibly dangerous. So I would never recommend anybody listening to a podcast like this do something like that. I think a way higher percentage bet is just to go debt free. Just get as far out of the financial system as possible and limit your exposure to the stuff that will be hurt most badly in a currency crisis, rather than trying to speculate on when and in what form the credit crisis hits. Now, owning gold is somewhere in between those two things, because you can own gold as a bet on a currency crisis, and that gold will go up in value. So were you to borrow money to buy precious metals, that might work. But again, you've got to be able to pay that interest going forward. So I think it's better for the vast majority of people to pay off their debts first, and then with the leftover capital, start buying, really well chosen, really conservative kinds of inflation hedges, if this is the scenario that you're convinced is going to come about.
I appreciate that you're bringing that to the personal level. If we could maybe go back and just hit that question on where they asked what happens to all those houses for which there are no buyers that the banks foreclose on. And somebody was just commenting on a different video we just did about the TARP program in their mind being a big fiasco. I was looking at a little bit of reading on it, talking about $700 billion was the original budget set out for the TARP program and so on. And the article I was reading said, and it's really been a great deal because it didn't cost the government anything, because the banks, those properties appreciated because they got them, they scooped them up at bargain basement prices, and then they were able to appreciate, and now they got out at a profit, and everything, and the Treasury made money on it, and everybody came out okay. I don't think that's the whole story, though. Can you talk to us, kind of walk us through who are the casualties in that confiscating of foreclosed houses, and what happens to those houses, and now they're being held by these banks, but there's no buyers because everybody's out of work. How does that really play out?
Here's what happened last time around. The government engineered a credit bubble, which manifested as a housing bubble, and caused a lot of regular people to go out and buy a lot of houses. The home prices then crashed, as bubble assets always do, and a lot of people couldn't carry their mortgages anymore, and the houses were repossessed. So people lost their houses. At that point, a lot of people, especially private equity investors, in other words, guys with a ton of money, came in, bought all those houses up at bargain basement prices, and then rented them out during the cycle, and made a fortune as home prices went back up, because governments cut interest rates to the point that it became attractive again to borrow money to buy houses. So the people who made money were the guys who are already rich, and the government bureaucrats and politicians who benefited from positive election results after they engineered a quote-unquote recovery. The people who lost were the people who got suckered into buying these houses by the banks, who were, in effect working for the government that was pushing interest rates down to unnaturally low levels. So this wasn't a good deal for regular people. It was a very bad deal for most of the people who lost their houses. And it was a great deal for the hedge fund and private equity companies that came in, bought everything up, and turned a nice profit on it. Now, this time around, there's not a housing bubble that's as frenetic as the last one. Houses are pretty expensive in a lot of markets, and there are some actual bubble markets out there, but that's not the epicenter of the crisis. Still, a lot of houses will be lost because a lot of mortgages were taken out on expensive houses in the last few years. And what will happen is, even if the bank that owns that mortgage goes out of business, the mortgage remains as an asset of the bank, and somebody will get it. So some other bank that didn't go bankrupt will buy up the assets of the bankrupt bank very cheaply, or the hedge fund guys will come back in and buy up a bunch of busted banks' mortgage portfolios. So because there's always somebody with a lot of money out there, the mortgages won't disappear. If you have a mortgage in a bank that goes bankrupt, you'll still have to pay that mortgage. Somebody will come after you for the interest on it. You don't know who it's going to be. It might go through 3 or 4 different hands before somebody comes to you and says, okay, you need to start making those payments again. Just because Bank of America's gone, that doesn't mean anything. I've still got this mortgage. So it's not guaranteed that we'll do it exactly the same way as we did last time, but we'll have to do some variation of a government bailout that makes the holders of financial assets whole, or at least an attempt. See, that's the thing. They'll try it, but will it work? That's the question this time around. Last time around, it worked amazingly, because the numbers were already so big in 2008 that I honestly didn't think they could engineer yet another credit bubble. But next time around, because the numbers have grown so dramatically, it's likely that the bailout, when it comes, and it won't just be housing this time, it'll be state and local governments. Illinois and California are going to need bailouts next time around. And it's going to be other governments, Italy and probably Greece again, probably several other European countries are going to go bust, and either we let the Eurozone implode or we help them out somehow. Corporations have been borrowing insane amounts of money to buy back their stock. Now the stock prices are going down, which means they're losing the money that they borrowed when they bought back their stock, but they still have to pay back the debt. And a lot of corporations will go bust. So somebody, either the Federal Reserve or the federal government or some combination of those two entities, will have to step in and bail all these guys out. We don't know the exact form of the bailout, and we don't know the exact timing of the bailout. But everybody who owes money to these guys will probably still have to pay it, whereas they won't have to pay back a lot of their debts because they have so much political power. And we have to remember, we didn't have to do it that way. We didn't have to bail the banks out. We could have bailed out mortgage holders directly and just said, you know what, you can keep your house. We'll just make sure your mortgage payments get covered for the next couple of years. And if your bank goes bust, we'll give you back your deposits that you have with the bank. And then you let Goldman Sachs and Citigroup and JP Morgan Chase cease to exist. And that would have sent a lesson to the rest of the financial system that bad behavior is punished by the marketplace. And it would have sent us a message to regular people that, you know what, the government has your back. We're not going to let you be ripped off by these banks. And I think we'd have a more stable system right now that was run more rationally and had mostly more rational economic actors in it than we do now. So next time around, it's conceivable that the people in charge will actually try. They call that the Iceland model, by the way, because Iceland actually did that when they had a crisis. But it's possible that we do it that way next time around, but it's unlikely because the big banks still run the government in a lot of ways.
So the two things are pressing into my mind as you describe this scenario, because it is very different from what would actually happen. One is this whole terminology about too big to fail. I'm not even sure what that means anymore. If you could say, no, wait, the consequence of letting something fail, why we called it too big to fail, was all these little people would have got hurt. So why don't you just go help the little people and not necessarily hold the elephant together? That's interesting. But doesn't it just, your second conclusion about rewarding bad behavior, but the bad behavior happened not only at the sovereign level and at the bank level, but at the individual level? Weren't lots of people being encouraged to, and in fact overbuying more house than they could afford, that kind of thing? So if you bail all those people out who no longer had a job now because the economy was in a downturn, but they still have this huge mansion that they can't afford, I mean, isn't bailing them out at the household level going to encourage bad behavior? Like people, just keep on overbuying and speculating at the individual level. Then
you could make the case that we shouldn't have bailed out anybody, because that's the way capitalism ought to work. It works by failure, basically. People push the envelope in an attempt to get rich, and then the very most extreme activities that they try blow up in their faces, and we all learn from that, right? Somebody goes bust, and then 100 other people learn what not to do. And the system, at least in theory, is run more rationally because of that, because everybody's afraid of what happened to that guy that they saw down the street. But the point I was making is that if we were going to bail anybody out, we didn't have to bail the big banks out. We could have bailed out regular people.
Okay.
And next time around, we'll almost certainly do bailouts again, because the political cost to the guys in charge of not bailing out widespread bankruptcies and letting the economy crash for a couple of years means regime change. You lose your job if you're the guy presiding over that. And if you have a choice of printing a lot of money out of thin air and trying to stop that from happening, or let it happen and be guaranteed to be kicked out of your job in disgrace, you're always going to print the money, right? As long as you have that printed press. Hey, one more thing. You mentioned too big to fail, which is a great thing that, to talk about, because it really is a myth that any bank could possibly be too big to fail. Because what is a bank? It's just a bunch of paper, right? It is a bunch of financial assets. And if JP Morgan Chase disappeared tomorrow, would that change the number of factories in the country? No. Number of hospitals? No. Farmland? No. Scientists? No. Number of patents on the books? No. All the real stuff that actually matters and creates value would still be here. We would just see a lot of derivatives traders and loan officers get thrown out of work. And then we might even benefit from that because they'd be driving taxis or something, or building houses, or, doing things that actually produce some value for some people. So this whole, the banks are too big to fail, is just a con that the big banks pulled on the government and everyone else. When they went to George W. Bush and said, you know what, if we don't get $1 trillion bailout by next week, there will be martial law. We'll have soldiers in the streets. And so Bush caved, but he didn't have to. And had he not caved, we would have had a bunch of big banks cease to exist. And then a couple of years later, we'd be in much better shape than we were 2 years after the bailouts. So that's another lesson that we could have learned but didn't learn. And because of that, probably won't behave accordingly next time around. We'll bail the big guys out again, almost certainly.
Well, I was trying to warm up to the other alternative of let's bail out the little guys instead of the big guys, but all of a sudden I got this chill up my spine. Please tell me if you can dispel this for me. But I remember a country western song that came out about that time of, I need a bailout, or something like that. It was basically saying, if the big banks need a bailout, I need a bailout. And okay, so that's true, but when you play that out, isn't the little guy getting a bailout eventually turn into universal basic income and socialism and free college and free health care and basically Big Brother being in charge of everything? Isn't that the loss of liberty and the loss of freedom?
Oh, yeah, absolutely. We shouldn't have an ongoing bailout regime because, as you said, it creates moral hazard. It creates the conditions in which you've got incentives to do things you would never normally do because you assume the risk has been removed.
Yep.
In some way. So you can't have that be a normal feature of society, as much as a lot of people would like it to be. The whole basic guaranteed income thing is in effect an ongoing bailout. It says no matter what you do, no matter how you behave, we're going to give you enough money to get by. And there are people who truly, through no fault of their own, deserve help. But we would create a whole generation of that other kind of person if we just indiscriminately handed out money to people. And yeah, I'm not saying we should have done that. I'm saying that we had alternatives last time around that didn't involve bailing out the big banks. We could have, and you could also make the case last time around that the people who bought houses at the peak of the cycle were conned by bankers who told them, yeah, you got good enough credit to buy a house. And the average person doesn't know what their credit is, right? Or only has a vague idea of their creditworthiness. And if somebody in a suit, in a nice office, in a big bank building says, you know what, you qualify for a $500,000 loan and you can get that house you've only dreamed of your whole life. Your kids have that backyard and there's that awesome school down the street. It's hard to say no to that. When someone in a position of authority is telling you, you can have this amazing thing. So a lot of people got suckered in because of that without being financially literate. They signed on the dotted line and bought way too much house and then lost the house, and they learned a life lesson that within a capitalist system will probably do them a lot of good going forward. In other words, they'll be a lot more cynical, as they should be, for the rest of their lives. But if you're a politician and you're going to bail out somebody, I would argue that bail out the guy who got conned and not the guy who did the conning. That's all.
Yeah, I'm just thinking a lot of our viewers are quite they value the virtue of self-reliance and basically having what you've worked for and having what you own and not expecting, knowing that if there's a hand that gives you something, it's a hand that can take it away, that kind of thing. And that's those are values that are largely being lost in our next generation, the millennial generation and beyond. So it's a concern it isn't just a dichotomy of the big guy and the little guy. It's this idea of whoever said that somebody needed to come give or take away your freedom, rather than it should be something you intrinsically that's part of being alive, and now go seize it and do something about it. But before we let the banks go, I wanted to give you one more question from Don Niespel, who asks, I've been hearing for the longest time that Deutsche Bank could be the crash instigator, and now everyone says the governments won't let it crash. What's the deal?
Deutsche Bank, I mean, doesn't that just sound like the most solid bank in the world? It's Germany's biggest bank. Germany is this financially conservative, highly efficient, productive society. And Deutsche Bank is their biggest bank. You would think that that would be the most rock-solid financial institution on the face of the earth, maybe ever, you know. And instead, they're the biggest players in the derivatives market. Now, derivatives are basically just bets that banks make between one another and with hedge funds and other big financial companies. So it's a casino, you know, nothing more than that. And the face value of all the bets that are out there now is approaching $1 quadrillion, which dwarfs the global financial system, the global economy, the global money supply. You know, none of those numbers are anything like as big as the notional value of the derivatives books of the big banks.
And some say that's so big, nobody really has their arms around it. Nobody can even state what the size of that is.
The human mind can't really understand $1 quadrillion or even $1 trillion, you know. Once you get past 1,000, most people just kind of break down. And then now we're into make-believe numbers when you get up around $1 quadrillion. But the losses that would result if even 1% of the derivatives market blew up would basically crash the global financial system. And this almost happened. You know, this isn't hypothetical, because in 2008, an insurance company called AIG was the Deutsche Bank of its time. It was the biggest derivatives player. And its derivatives books, basically what happened was a lot of the people on the other side of the bets that AIG had made started to go bust and couldn't pay AIG, which means AIG couldn't pay off on its derivatives, and it was going to go bankrupt. And it was going to take down Goldman Sachs and JP Morgan Chase and Citigroup. They would have ceased to exist if AIG's derivatives book blew up. So the U.S. government had to step in, and or felt like it had to step in and bail these guys out. And that's where one of the biggest chunks of the bailout went, was to keep AIG going so that it didn't take down all the other big banks, many of whom had executives who were running the Treasury Department and the Fed. You know, those guys were not going to let their employers, past and future employers, go bust. So they stopped that process in its tracks. And, you know, it would have been interesting to see what happened there, because, you know, at that time it was about $500 billion worth of notional value of derivatives. And it would have been fun to see that happen, frankly, but we didn't get the chance to see. Now, this time around, the numbers are bigger. And some people say that the U.S. banks are better capitalized, and other people will say that's not possible because of the derivatives books. You know, they can't be well capitalized if they have this many bets out there that could blow up on them. Anyhow, Deutsche Bank is getting into trouble with a lot of their business practices. They're constantly being sued for committing crimes and having to pay big fines, and a lot of their business isn't working the way it used to. They're not making as much money as they used to, and people are becoming increasingly worried that at some point in the not too distant future, Deutsche Bank is going to fail. And then the question becomes, what happens to its humongous derivatives book? And the answer is nobody knows. As you said, nobody knows how this stuff works. Nobody knows where the other side of all those bets lives. They don't know which hedge funds have what, which other big banks have what, because this is a mostly private market that doesn't have to be reported in any kind of detail to the SEC or any other regulatory agency. So that stuff's out there. I mean, they report the gross number of derivatives, the gross value of them. So we know the other side of them exists somewhere out there, but we don't know who has them or what they're going through. And so, yeah, Deutsche Bank could be the AIG of this cycle. In other words, it could be the financial entity that blows up first and threatens to take down a lot of other financial entities. course, there's a lot of other candidates for that job. There are 5 or 6 things you can point to and say, oh yeah, that's the thing that's going to go first.
You made a comment that will always stick with me at the first Liberty Mastermind Symposium, where you said that, I forget exactly how you said it, but it was something to the effect of, there's an almost infinite number of things that could go wrong and go wrong very badly, or something like that, that there's just so many possibilities. I guess circling back to the heart of this one, they're asking if Deutsche Bank is a potential linchpin or stone at the bottom of the dike, or whatever you want to call it, but the government seems to be committed to preventing its failure. Do you believe that it can be kept up in perpetuity, that there's always one more trick that the government can play to keep Deutsche Bank from the consequences of its own behaviors, and prevent this whole thing from falling down around its shoulders?
Yeah, well, it comes down to the value of the big fiat currencies. As long as the dollar and the euro and the yen are perceived to be valuable and stable, then they can issue as many pieces of these currency as they want to. Mm-hmm. And that allows them to manipulate the financial markets and bail people out and do all kinds of other things, fight wars to their heart's content. But as soon as we lose faith in the currencies, then it's game over. And we can't know when that's going to be. We're seeing signs of instability out there and signs of inflation in the financial asset markets. So it's possible that day is coming soon. Think of it as, to go back to the analogy of the family that's maxing out credit cards, you don't know when the last credit card that blows up your financial life is going to end up in your mailbox. You don't know which one will do it, but you're going to continue to max out credit cards until one day you miss a payment, and all the payments, all the interest rates on your credit cards go up to 22%, and boom, it's over for you. So we've got that day out there in the global financial system. We don't know when it's going to be. We don't know where it is on the calendar. We don't know exactly what will set it off. And we don't know what the consequences will be, but it's fairly safe to say that the consequences will be pretty serious. It'll be a really, really chaotic, terrifying time for most people.
Okay. You've talked some about a foreign bank, in this case Deutsche Bank. This is a related question, and you've mentioned how the fiat currency phenomenon is not just a U.S. phenomenon. It's a worldwide phenomenon. This one, it gets to that. Anti-Ignorant asks, how will the dollar collapse affect other countries, like, for example, Poland? What about inflation in Poland, bank runs, bank collapses, interest rates, exchange rates from the Polish notes to the U.S. dollars? What about the prices of gold and silver in Polish currency? What to expect? So that's just one country as an example. But how does, for example, a dollar collapse? And you run dollarcollapse.com, so it's fair to ask you that question. How would a U.S. dollar collapse likely be felt in either emerging markets or other established Western markets?
Well, a dramatic decline in the value of the dollar would affect a lot of different people in a lot of different ways, because most national central banks out there own dollars as their reserve currency, as their monetary reserves, which they use to back their own currency. So if the value of the dollar declines dramatically, then that affects your own currency.
That's an asset. That's an asset on their books, is
yes,
dollars?
Asset. Yeah, and so if that disappears, that means their currency isn't backed by anything anymore. Trillions of dollars of bonds are denominated in dollars out there. We don't know where all those bonds are, but it's a safe bet that in every country there are lots of people who own treasury bonds, right? And if the value of the dollar were to plunge and treasury bonds lost a lot of their value, then a lot of people in a lot of countries would see one of their big important assets lose its value, and maybe a lot of them would go bankrupt. And so you would get kind of a cascade failure of your own financial system because of this thing that happened halfway around the world in another currency, just because a lot of your people owned a lot of assets denominated in that new currency. And see, that's just the immediate effect.
Yep.
All the secondary effects would just be so crazy when currencies start spiking and crashing against each other, and some assets soar in value and some assets crash in value, depending on their relationship to these currencies. It's really hard to predict, but it's safe to say that nobody comes through it unscathed, because it's the dollar. It's the world's reserve currency. And the euro is the number 2 currency in the world, and Pound sterling is still very important, and the Chinese yuan is very important, and the Japanese yen. All of these things are very important out there, and any one of them blowing up could cause a ripple effect around the world. So details are almost impossible to sketch out once this thing gets going, because it really is a chaotic system out there when the crucial financial assets in the world turn out to be the junk bonds of this cycle. And that's really what we're headed for at some point. Fiat currencies will be the epicenter of the crisis. They'll be the subprime mortgages of a global financial crisis. Only instead of a few $100 billion in one sector of one economy, like the mortgage market was last time around, this is everywhere. It's the whole world. So there's really no way to know how it plays out except to say that it's going to be chaotic and terrifying.
So those specific questions that the viewer was posing about pretend this person lives in Poland, I don't know, and they pretend that they're asking whether they should maybe hold some Polish currency as a hedge against the U.S. dollar collapse, or gold and silver versus the Polish currency. What you're saying is, and you've said this a couple of times in this interview, is gold and silver, being real things, are likely to weather somewhat make this storm somewhat less chaotic than fiat currencies, where all bets are off, but that it's just it's maybe too unpredictable to say what the Polish currency is going to do against the U.S. currency. It depends who blows up first.
That's unpredictable. Yeah. What the Polish currency would do. They're not in the euro yet? Oh. Okay, but the advice, if it's going to be a global currency crisis, the advice would be the same for everybody everywhere, which is, like you said, real assets. Own things that governments can't create in infinite quantities, and you can expect those things to go up relative to the currencies that they're just churning out to try to stave off collapse. And remember, this is kind of what happened last time around. We created tens of trillions of new dollars and euros and yen last time around. And for 5 or 6 years, real assets went through the roof. Gold and silver were the best performing assets in the financial markets. Oil stocks went up. Farmland got more valuable. All the things that you would think would do well in a world where the currencies aren't doing so well, it did great. And this wasn't even it. This wasn't the big one. This is just a foothill on the way to the mountains. Like Peter Schiff says, the real crash is still coming. This was just a warm-up.
Something you just said made me think about this last question. This is JS saying, I'm earning 4% on 20-year-old EE bonds and 5.5% on I bonds. Does John suggest I cash them in now, or should I wait until the maturity date? Thank you in advance. So before we even let you answer, reminding everybody, this is not a financial advice giving show. You're not here as a financial advisor to anybody, an individual. But the principle that's being promoted for discussion is, and it reminds me, there's a scene in The Lord of the Rings where the two, I can't remember, there these two elves that were not elves, they're hobbits that were helping, and they're riding on Treebeard the Ent back to Isengard, which is where Saruman, one of the bad guys, lives, and he's trying to convince them they'll be looking everywhere else for us, and the closer we are to danger, the safer we are. So here's someone who's holding on to the heart. They're holding on to U.S. government savings bonds, and they're wondering, should I keep hanging on to these if they're going to be are these going to be at the epicenter? Are U.S. bonds likely to be, in our view, a higher or lower risk position in the event of a collapse of everything around us, at the end of all things, as they say in Lord of the Rings?
Well, as you said, I'm not an investment advisor.
That's good. Good way to start.
What any person should do with their money. But speaking theoretically and generally, when a currency starts to decline in value, then bonds that pay you that currency a little bit at a time go down in value also. And we've got an example of this historically. In the 1970s, interest rates went way up because inflation went up. In other words, the value of the dollar dropped dramatically during the 1970s, and that forced up interest rates, which is the same thing as saying it forced down the prices of bonds. So you could own, a 30-year treasury bond, the safest asset in the world. You're definitely going to get paid because the government could create as much new currency as it wants to, and it will definitely pay you. And you still could have lost half your money by owning a portfolio of those bonds because their price went down when it was perceived that inflation was going up, which made the money, the coupon that bond paid you, less valuable. So that's one scenario. You know, in the currency crisis scenario, government bonds become less valuable. Now, the other possible scenario is another 1930s style deflationary crash, right? When all this debt hits and it's allowed to go bust. So it gets wiped out through default. Everybody goes out of business. They can't pay their bills. The banks go bust, et cetera, et cetera. That's what happened in the 1930s. And in that environment, government bonds did really well because they were the safest asset. And so you wanted to own government bonds during a deflationary crash. You didn't want to own them in the 1970s during inflation. So to the extent that we're probably going to try to engineer another 1970s style inflation in order to make our debts less onerous, then government bonds are not the best place to be. In fact, you'd be a lot better off in the equities, which are normally a lot riskier than bonds, of really high quality multinational companies, companies that can raise their prices to keep up with rising inflation and spread their sales out all over the world. They would probably do better than government bonds, even though government bonds are today perceived to be a lot safer.
Just to follow on question there, since he does mention the Series I bonds, which are supposed to be incremented or indexed to inflation, but is there a pitfall there of this is the officially government recognized inflation, which is never going to pale in comparison? Just like when people were making bets on the volatility, the VIX, and they were seeing it was unnaturally, just eerily steady for the last several years. And all of a sudden there was this huge upset in February, and everybody went running to their screens and saying, "Wow, did the VIX spike?" And it's like, no, it didn't. It didn't get the spike that we were expecting here. What? Even when I bet on volatility, I didn't win.
Yeah, that is a very good point. The I bonds are at least partially protected against this scenario. When inflation starts going up, you'll get something more with it. Although I think it's capped. I'm not sure about that.
Probably is, but also your point is the most you can get paid back in is dollars. And
yeah, they're only going to give you dollars, and they are going to lie about the inflation rate. That's one of the ways that they're going to try to manage this transition, and they're going to do it for Social Security recipients too, where your cost of living might go up by 4%, but the government's going to announce that your cost of living went up by 2%, and only give you a 2% raise. So your real Social Security check will diminish in size. And they'll use that as a mechanism for limiting government spending, for keeping it from just running out of control. And they'll do it by lying to you, basically. So it's reasonable to assume that they'll do that with inflation-indexed bonds as well.
I think we could go on all night, John. I know that we're running at the end of our hour here, and we just appreciate your time to no extent. Or to no end. But if you could remind people where they can reach you and where they can find out more of your work, if they want to get plugged into your work, where can they find you?
Well, I run dollarflaps.com, which covers this stuff on a daily basis. So the idea is, show up in the morning. You'll see links to what happened overnight, and you'll be up to speed on the dark side of the financial system.
And the closer we are to danger, the farther we are from harm, was the quote from Pippin on Lord of the Rings. I dug it up while we were talking. So thank you, John Rubino, as always, for joining us here on Reluctant Preppers.
Thanks, Tony.
They say the stock market crashed today.
Yeah, I heard that.
Sounds like people's retirement accounts and savings accounts are going to get bailed into the banks.
Yeah.
Looks like pension plans and Social Security are going to get suspended too.
I know.
Sure, I'm glad we decided to put our money into gold and silver instead.
Me too.
Get your first ounce of silver at spot price and free shipping on any order over $99 at sdbullion.com/RP.